Many mutual funds report having delivered superlative performance, but you will hardly find investors who have got this return. Perhaps a handful. Most investors have lost money or have not made good returns. In this video, we are going to analyze if the funds have really delivered that kind of a return that they claim, or is this just a marketing gimmick? Is there something they are not telling us? The reality could be very different. You will be shocked to know that many mutual fund managers themselves have admitted that investors have not received the returns that their funds have reported. This may be shocking, but it is true. Check this report by Axis Mutual Fund. They conducted an analysis on Indian investors' behavior, that is, buy and sell decision, and how it impacted their returns. They looked at fund returns under different modes of investment, that is lump sum, buy and hold, and systematic regular investments such as SIPs. It found that investor returns were worse than the fund returns in either of the two scenarios. And shortly, I will also explain why this has happened and what is the solution. First, let's understand what is happening. While the fund returns were 22% during this period, the investors made only 15% return in the same funds. That's almost 7% lesser per annum. That is, 1 lakh invested in the fund at the beginning of this period would have grown to 10.87 lakhs by the end of this period. However, an investor who has invested in the same fund during this period would have grown to only 5.69 lakhs, almost 5 lakhs lesser than the fund return. This is called investor return versus fund returns. So 5 lakhs has leaked. It has evaporated due to reason I am revealing here. Most investors rely on past returns before choosing a mutual fund. We know performance of a fund goes through ups and downs. So when an investor is choosing a fund that has done very well, it is at this stage where the history is very good. Now when you enter at the top, and if the fund performance, which is cyclical, starts to go down, then you have just seen negative returns. You might have lost money, and sometimes the underperformance goes on for a few years before the fund picks up. As an example, look at the PGIM funds or Axis Mutual Funds. They have underperformed for the past few years. Before that, they were the stalwarts, having delivered the best performance in the industry. There was mad rush to invest in these funds like Axis Focus 25, PGIM Mid Cap. They were at this stage. Now, relatively speaking, compared to other funds, they are here. These are just cycles, and good fund managers, good funds come back. Like ICICI and HDFC, value-based funds, they were underperforming in the previous cycle. Now all of a sudden, they are the chart busters and the top performing funds. So one reason why investors do not make money is that they sell their funds at the bottom, just when they should be investing more. For example, the interest in investing in an Axis or a PGIM fund today is very low. But these are just cycles. Look at the data from AMFI. 48% of the investors, that is almost half, sell their mutual funds within 2 years. This represents the typical cycle of their investment period. I am using this visual only to explain this concept. It is just a relative depiction of what is happening. This is similar for short-term investors too. They often lose more than what they gain from the fund returns. If you need a copy of this report, please ask for it at this email. When the returns of these funds are high compared to the average Nifty returns, investors get tempted to invest in focus funds that have just delivered 38% returns, or sectoral funds that have given 44% return, or thematic funds that have given 45%. These seem attractive compared to the average market or the Nifty 50 returns of 26%. However, if you look at the long-term performance of these funds, the returns decline and converge to a lower average, proving that initial high returns are often unsustainable. This explains why, after an investor invests, the fund's performance seemingly starts going south. The third reason is more subtle and not easily visible to the layman. It's an interesting concept that often goes unnoticed unless explained. This is particularly true for investors in small cap and mid cap funds, which have delivered the highest returns in the past. When the market undergoes a correction, which is a normal occurrence as markets go through cycles of volatility, investors often struggle psychologically. Although it's common knowledge that what goes down eventually comes back, investors find it challenging to remain invested during these temporary losses. Many of them end up selling during market corrections, converting temporary loss into permanent loss. As investors sell off their holdings, fund managers are forced to liquidate quality stocks, liquid stocks, to meet the redemption demands. This results in the portfolio being left with low quality stocks, and these are not easily sellable due to lack of demand. Consequently, additional selling puts more pressure on the prices of these stocks and they start declining even further. Investors who have invested in these high-risk funds experience a further drop in the fund value, leading to sharper losses due to this liquidity risk. Knowing when to invest in these high-risk funds is key. I would say investing in them when the past returns are bad would be a safer approach. I have covered this in this video in detail. If you have not watched, please do check it out here. Pareto's principle also comes into play here. Take any year, such as 2023 for instance. In that year, the Nifty 500 index returned 27% for the calendar year. However, the top 10% of the stocks generated a whopping 166% return, while the top 20 stocks alone generated 128%. Essentially, the top 20% of stocks generated the maximum return, while the remaining 80% actually dragged down the overall returns. This pattern holds true for any year. For instance, in 2018, when the index saw a decline of -2%, the top 20 stocks still managed to generate a positive 26% return. The point is, it is difficult to predict which are these 20% until the event has happened, showing how investors think and how reality pans out. It captures the essence of the unpredictability of market events and of investor behavior as well. This highlights the disparity between investors' expectation and market realities. It underscores the importance of adopting a cautious, disciplined approach to investing, focusing on long-term goals than short-term trends. This screen proves this again. This is the return stocks have generated while the Nifty moved from 20,000 to 23,000 level, which is a 15% return. While Nifty delivered 15%, the top 10 stocks delivered outsized return. For example, Bajaj Auto gave 86% return, almost 5 times Nifty 50 returns. Airtel gave 4 times more than Nifty 50. Hero Motors also gave more than 4 times Nifty 50 returns. Coal India delivered 78%, has delivered more than 5x Nifty 50 returns. Is there a way to identify these 10% or 20% stocks in advance? Please leave your comments in the comment section. To invest in mutual funds, please register here or email. For more interesting insights on mutual funds and equity investing, do subscribe to this channel and watch other videos. Please like and subscribe.